Welcome everyone to our webinar for today. We have some really important information we're going to be talking about. It's the capital gains change that's happening this month, June. And the two people who are going to be talking to are Carlo Cancino and Mike Connon, both senior financial advisors at the McClelland Financial Group. They have some great recommendations for you today, so let's just jump right into it. To start, we're going to talk a little bit about us if you don't know who we are. We're going to go into the history of the capital gains inclusion rates, how they may affect you. We have a couple case studies to walk through. Some of these situations may apply to you, and then our recommendations. At the very end, we have a Q&A, so if you do have any questions, please add them to the Q&A box down below. If you don't know who we are, at the McClelland Financial Group, we help investors in Toronto and across Canada achieve their financial goals using evidence-based investing fueled by relationships and not commissions. We work in partnership with you towards your end goal, a happy, successful, simplified financial life. We combine the strength of Assante Wealth Management resources with the expertise and personal touch of our trusted financial advisors. So let's jump right into it. Mike?
Hi, thank you, everyone. Thank you for joining us on this webinar. It's a great way to communicate with everyone, and particularly when we have things like this come up, a big change in tax regulations that not everyone fully understands, and we can make everyone aware of this. So it's a great thing to be able to talk to everyone all at once. I'm going to start off by talking about capital gains, and let's start off with what is a capital gain. Capital gain is basically the difference between the total cost, let's call it book value or adjusted cost base, and the sale price of a item or the market value. And that would be a property or stocks or anything like that. So let's use an example. Let's say you bought 50 shares of a stock at $100 each. So you paid a total of $5,000 for that purchase. You later sold all those 50 shares at $150 a piece. So you received a total of $7,500 for that sale. The profit would be about a $2,500 capital gain. So that's essentially how capital gains work. You can get a little bit more complicated than that if you buy stocks and they're on a dividend reinvestment plan. Those reinvested dividends add on to the adjusted cost base or of the item. If you buy a property and you do capital improvements on that property, let's say you spend money and you go and throw a new deck on a cottage. If you spent, let's say, $10,000 or $20,000 on that deck, and you paid $500,000 for the place, your cost base would go up by the $20,000 you spent on the deck. It now be $520,000. So that's a brief example of how capital gains work. Let's talk about the history of capital gains and where they came from. Capital gains first got introduced in Canada in 1971. And you can see in 1972, the capital gain rate was set at 50%. And alongside, we've shown a bit of an idea of who the prime ministers were that time. And again, Trudeau, not this Trudeau, the other Trudeau, was the prime minister back then. And that went on from 72 all the way to 1988. In 1988, they started to hike capital gain rates. They went from 50% to 66.67%. And then within the next 2 years, they rose again to 75%. And they stayed that way for a decade. And until around February of 2000, they dropped to 66.67%. And then within that actual same year, they dropped to 50%. And that was under the Chrétien government. The funny thing is we keep on, this capital gain issue seems to be taken in a very political stance where it's going to be liberal or conservative stance. But the odd thing is when we look at the prime ministers at the time, it was originally introduced under Trudeau, but it was raised under Mulroney, who was a conservative, and then it was brought down previously by Chrétien, who was a liberal. So I guess it's not really fully dependent on the party. It depends on who's in charge, and more than that, what the needs of the government are at that time. In 1985, the government also introduced a lifetime capital gain exemption of $100,000. For those who are a bit older, you'll remember this back in 1994, where everyone was trying to crystallize the gains and their losses to take advantage of that $100,000 capital gain exemption. So what are these proposed changes? The federal budget increased the capital gains inclusion rate on June 25th, 2024. Now remember, it increases on June 25th. So if you want to be in the lower inclusion rates, a sale of anything has to be finished before June 25th. You have to be done by the 24th. For individuals, the first $250,000 in capital gains still remains at the 50% inclusion rate. But the change is any amount above that $250,000 will now be included at a 66.67% inclusion rate in there. Corporations will now be charged, so this is another big change. Corporations will now be charged 66.67% starting on the first dollar of capital gains. So that cushion we have on the personal level does not exist on the corporate level. So that's going to make a big difference in corporate financial planning. So how will this affect me? That's the big question to everyone. So let's go through different scenarios. First of all, secondary property. If you have a cottage or a rental property, any capital gain over $250,000 will be taxed at the 66.67% inclusion rate. So your first, again, 250 is the same 50% inclusion rate. Once you go over that, it's going to be at the 66.67% inclusion rate. And remember, the properties are not only if they're sold, it's also if you decide to pass on to a family member, like a child or anything like that, that's considered what we call a deemed disposition, as considered sold. For non-registered or open accounts, any capital gain above that $250,000 threshold will in any year, will be taxed at the 66.67% inclusion rate. Again, the first $250,000 is the 50% inclusion rate. Above that, it's going to be 66.67. Trusts and corporations. Again, as we said, this is a big thing. Capital gains will now be taxed at the 66.67% inclusion rate, starting from the first dollar of gains. And as Carlo will explain later, this is not only the corporations that you think is companies, but doctors and dentists and a lot of people we use as professionals in our lives are actually registered as corporations. So it would truly affect their income. Effect on estates. So the easiest way to describe it is everyone's last word is sell everything I own. So the last thing you'll say in your life is sell everything. And when you pass away, you're deemed to have disposed everything at fair market value. And any gains that are inherent in those, let's say stocks or properties or anything like that, is triggered at that time. So at the time of death, any capital gain over $250,000 will be taxed at the 66.67 inclusion rate. So a few things that we had as complaints on how the government introduced this. Number one is when they said it was going to affect 0.14% of Canadians. And it seems a little bit ridiculous. And everyone who's watching this webinar right now, so either a secondary property, a non-registered account over $250,000, trust or corporation, affects from $1. So anyone who has a company is affected in this. And let's put it this way, anyone who dies or has a relative that dies is going to be affected by this. And when you look at that, that's way over 0.14% of people. They went and took that number off who put on their tax return over $250,000 gain last year. So obviously that's not very indicative of what the cost will be to people. So with that, let me pass it over to Carlo here. And Carlo's going to walk you through some case studies to show how this actually affects people.
Thank you, Mike. And good evening, everyone. Appreciate you going through the history of capital gains, explaining where they came from and why they're here. You talked about the technical aspects of capital gains. Let's walk through some practical examples, the way that these changes are going to be affecting us and the audience members. So let's take a look at 4 different case studies, starting with selling a secondary property. And so we talked about it already. I think there was a stat that said that just under 10% of Canadians own a cottage. So that's well above the 0.13% that the government had talked about these changes impacting. Likely with cottages, there's going to be larger than a $250,000 capital gain. So let's start with that. So you purchased this secondary property in 2000 for $750,000. For this example, let's assume there's no capital improvements, so the cost base is $750,000. Let's say you sell it next year, 2025. The market value at the time of the sale is $1.5 million. That is a $750,000 capital gain. So what is the impact of the new rules on the sale of this property? So before the changes, if the sale happened before June 25th, the $750,000 capital gain would be subject to the 50% inclusion rate. So only half of that capital gain gets included into your income. That's $375,000. After the June 25th changes, the first $250,000 is at that 50%, so that's $125,000. But the remaining $500,000 capital gain, 2/3 of that is included. That's $335,000 plus the original 125 is a total gain of $460,000. That's under the new rules. Under the old rules, it was $375,000. That's an increase of $85,000 in capital gain income, 23% increase.
That's big, Carlo.
Yeah.
Tell us about the inclusion rate, just in case people don't write, you know, sometimes we talk about this stuff, inclusion rate. What does this all mean?
Of course,
Yep.
inclusion rate versus tax rate, very easily confused. The inclusion rate is how much of that capital gain you have to include in your taxable income for the year that it was triggered. The tax rate is essentially that marginal tax that you pay on that additional income that you add onto your taxes for the year. So under the old rules, a $750,000 capital gain, the inclusion rate is 50%. The income amount is $375,000, and whatever your income is on top of that $375,000 will put you in a marginal tax bracket, and so that's the tax rate that you'll be paying on that income.
So when you look at this example, that 375,000 will be added to your actual income,
Yes,
which would be at your current income rate. If it's 50%, you'll pay half that in taxes.
that's
And it's
correct.
increased to 460,000. If that gets added, that would increase your taxes on that.
Yeah.
And I guess it can also change your marginal tax rates too, can't it?
Absolutely.
Yeah.
For those of you that are aware of the marginal tax rates in Canada, top marginal tax rate in Canada is 53.53%, and that's on income above just over the $230,000 mark. So as you can see in these examples, that's going to put you at the highest marginal tax bracket. Number two, clients passing away. Now, Mike mentioned again earlier about estates and the effect that the new changes will have. Let's look at a scenario with different assets that the deceased had and how the changes would impact them. So net worth on the date of death. You had a principal residence, which was purchased for $500,000. The cost base is $500,000 and worth $1 million at time of death. There was a cottage, a second property, purchased at $300,000, now worth $550,000. You have a non-registered investment account. The book value or the acquisition cost, $300,000. When you passed away, it was $500,000. You have a RIF or a registered retirement income fund, purchased or the cost base was $150,000, market value $220,000. And finally, a tax-free savings account, $95,000 cost base. You were able to maximize it throughout the years that TFSAs have been available, and at time of death, worth $175,000. How do the new rules impact this scenario? So on your home, as most know, your principal residence is exempt from capital gains, so no capital gains impact there. Your cottage, the capital gain was $250,000. The non-registered account had a $200,000 capital gain. The RIF, again, registered accounts, there are no taxes on income earned in the year, so no capital gain inclusion. But remember, the value of that RIF is added into your taxable income in the year that you are gone. And finally, the tax-free savings account, no capital gain implication. Just as it sounds, it's tax-free growth. So in this scenario, total gains, $450,000. Under the old rules, the inclusion rate's 50%, $225,000 of taxable capital gains. After the changes, the first 250, 50% inclusion, $125,000 taxable capital gains. On the next 200,000, that's 67%, an additional 134,000 taxable capital gains. Total, just under 260,000. The difference between the two, $34,000 increase. Under the new rules, that's a 15% increase in this scenario.
Oh.
Non-registered account. Let's talk about something a little more current. Many of you may be aware who follow the market. Big tech stocks have been soaring lately. One stock in particular, NVIDIA. Let's use that as an example for a non-registered account. Back in September of 2023, if you invested $1 million into NVIDIA, the share price at the time was $500 a share. You could have bought 2,000 shares. May 2024, the price has more than doubled. It's now $1,100 a share. Total value of your portfolio is now $2.2 million. What would happen if you liquidated? Capital gain, difference between the two, 2.2 minus $1 million, $1.2 million in capital gains. Before the changes, you're including $600,000 in your taxable income. After the changes, you're adding in 761,500 in taxable capital gains. A difference of just under 162,000. That's another large increase of 27%.
You wouldn't want to be a day trader now, would you? You just
Absolutely.
got 27% of your income taken away.
Yeah, but with most day traders, they see that number, probably not selling because they're feeling
Yeah.
the greed and they just want to see more growth.
Yep.
Final scenario, a business owner, like Mike was talking about, medical doctors, dentists, professional corporations that are owned, trying to take advantage of the tax benefits within it. Let's see how a corporate investment account would be impacted. So within this corporation, there's $1 million market value on the non-registered account. The cost base on this portfolio or book value, $500,000. A sale of the portfolio at 1 million triggers a $500,000 capital gain. Under the old rules, you would be including $250,000 in taxable capital gains. As we know, with corporations and trusts, there's no $250,000 threshold at the 50%. So after the changes to the inclusion rate, that's the full $500,000 at the 67%. That's a total of $335,000 of taxable capital gains, an increase of $85,000. That's a 34% increase to income for that corporation. So those are the 4 scenarios that we were going to look at. Again, these changes have come pretty fast and furious. And you might be thinking, should I be making changes at this time in order to avoid these financial impacts? Mike, why don't you walk through some of the recommendations?
So let's start off and talk about personal accounts. So in most cases, in a personal account, because that $250,000 cushion we have, there's no immediate need to do anything. If you have ability to trigger capital gains for multiple years, you should try to do that. So for senior clients, so if you're 50 years old, I wouldn't worry about it too much. But if you're, let's say, 85 and you have $1 million worth of gains, it might make sense to start triggering a piece of those gains each year and keeping each year under that $250,000 threshold. So over the next 4 years, you would trigger gains at a much lower tax rate. So that's one thing that makes sense. Secondary properties. Again, not much can be done because the one thing we had, I guess the issues we have with the government and what they did on this, number one, we never like a tax rate. Obviously, we're against that. So we're not thrilled about that. But the notice that was required to do this just did not seem to make sense. Within 2 months, because getting rid of a stock is easy, getting rid of property is not that easy. The land transfer departments couldn't even handle it.
Yeah, right.
So people have a lot of things they want to do to plan taxes, but the timing and the illiquidity of the land in houses is getting in their way. So they can't really do much about it. So that's the one real problem. The other thing with the lack of liquidity, when you trigger these gains, by April next year, you got to pay the tax. So this is something that's being offset into the future is now a current expense. So you got to take that into consideration. So again, the other thing to consider too is these capital gains are $250,000 per person. So if a couple owns a house jointly, they have $500,000 worth of income that will still be in a low inclusion rate. Trusts and corporations. This is a bigger issue because in trusts and corporations, there isn't that pillow we have or cushion of $250,000. From $1, you're now at the 66.67% inclusion rate. So it becomes a big question whether to trigger it now or to wait. Most accountants we have talked to that when people are holding the money inside the corporation for, let's say, 6 or 7 years, have said it makes more sense not to trigger them. Why pay the taxes now, right? Because you're going to pay that money now. That money is no longer going to be working for you. They'd rather have it in the account growing. And we saw some break-even analysis. And usually around the 6 to 7 year mark, it makes more sense to leave the money in the corporation and not trigger the gains, pay them later, even though it's at a higher rate.
Mike, what happens if business owners are looking to take money out more soon?
You should probably start to trigger some gains.
Yeah.
I mean, if you're going to take a heavy dividend or heavy distribution, let's say you're going to wind up the company in the next 5 years, probably makes sense to trigger those gains now under the lower rate before you have to do that. So it's going to have a lot of effect on people's plans, as much as we talk day traders. People have to rethink how they're invested. So particularly inside corporations, when you use any type of ETF or mutual funds, they're going to distribute dividends and capital gains at the end of the year. So you're going to find you're going to want to use funds with a much lower turnover, because on every dollar turnover they're triggering every year, you're going to pay those capital gain taxes at a higher rate now. So people have to really consider when we invest. We always talk about headwinds, things that get in your way. And, headwind, we always like to work in a low fee environment because fees are a headwind. They slow down your performance. And tax is another headwind that you have to deal with. And this headwind has just got a fan behind it now because it's got a big boost. So again, now on the corporate side of things, we have a higher headwind. So you have to be really careful to use, let's say, more of a passive approach that isn't going to have a high turnover and trigger these capital gains on an ongoing basis. So I'm going to hand it over to Ingrid.
Thank you, Mike. Thank you, Carlo, for that explanation. We're going to be moving over to questions. So if you do have any questions that you have not yet put in the Q&A box, please do so now. We're going to start off. One question was, what was the difference between an inclusion rate and a tax rate? Could you re-explain that?
Sure, I can walk through that again. The inclusion rate obviously differs from the tax rate. The inclusion rate is what you have to include of that capital gain. Under the old rules, it's 50% of the capital gain. So on a capital gain of $750,000, 50% of it is $375,000. That's what you have to include in your income for that year. Whatever your other income is for that year will determine what your tax rate or marginal tax rate is that you're going to pay tax on that additional income. So inclusion rate is how much of the capital gain you have to include on your taxes, and the tax rate is just the marginal tax rate that you will pay on that next dollar earned.
Perfect. Thank you, Carlo. A question that we're getting from a lot of our audience members is, if you own a secondary property with your partner, can you split that capital gain? And to go along with that, can you split it even if there's only the property under one of the spouse's name?
Yeah, I can start. Like Mike has mentioned earlier, the capital gains threshold is per owner. So let's not even stop at partners or spouses. If there's a property that you own with multiple owners, say there are 3, and the capital gain after the sale of the property is $750,000, you determine what the capital gain was per owner at the sale. So if there were 3 owners and it was a $750,000 capital gain, that means $250,000 is the capital gain for that owner. The inclusion rate is 50%.
I guess the other part of the question was if it's a single owner. So unfortunately, if it's a single owner, it goes under a single tax return. So if you have, let's say, someone put the cottage in their wife's or husband's name, and it stayed in that name, and all of a sudden they go to sell it, unfortunately, because it's in one name, it's going to be taxed under their marginal tax rate. Same with companies. If companies owned by one person, unfortunately, you can't split that income. It's going to go to one tax rate.
Thank you for that. Another question that's being asked a lot is for personal accounts or your open accounts. When does it make sense to start triggering those gains?
For open accounts, much we discussed, when you start to get on an open account, as people get older, it may make sense to start to trigger some of those gains along the way, because we know as an estate liability, it's always pretty heavy, because the last word for everyone is sell everything. So everyone usually has number one, a top marginal tax rate upon their death. And if they have a cottage and stocks and all that stuff, it all gets put together on the second they die to establish the capital gain. And it can be quite high at times. So many times that final return will have everything at the top marginal rate. So if you can start to take down those taxes or that later tax liability, while people are alive at lower inclusion rates and lower tax rates, that may make more sense to do. Also, an interesting thing I'd say is what we'll probably start to do is when one spouse passes away, we'll probably try to trigger that $250,000 worth of capital gains on the first. If we have 2 spouses that are in their 80s, when the first one passes away, we'll probably try to trigger that $250,000 under the spouse that passes away. We used to pass that directly on to the surviving spouse, but that may not make as much sense anymore because of these new capital gain inclusion rates.
Yeah, great point, Mike. Typically, when we had one spouse pass away, the ownership or the property would go to the surviving spouse at cost. And that means you're just deferring the capital gain to the death of the survivor. Whereas knowing that the inclusion rate, it will jump up to 2/3 after $250,000. That does make sense where upon passing of the first, you trigger $250,000 of the capital gains, and then the remainder will get deferred until the death of the survivor.
During these times is when you really need your advisor and all your professionals working together, your accountants, your lawyers, and your financial advisors. And they can make a huge difference in what you're going to pay in taxes and this. So this is a big deal to go and talk to your accountant. And we love talking to accountants. So if you get a chance and people say, I'm overwhelmed by my accountant, we'll just have them call us.
Right.
And usually the accountant will give us a plan. We'll go and make their plan come true and make it so everyone pays less taxes. You can have a lawyer set up, particularly real estate type of changes. They can do all that. So if you have all your professionals in your life working together, it gives you a huge advantage. And I wonder at times like this, when people try to do things on their own, it's very difficult to think of all this stuff. And that's all we do is read all the details on, let's say, strategies to reduce this as much as possible.
Well, that's a good point to make, Mike. You have an accountant, a lawyer, a financial planner to help put you in a better financial position. Nobody is trying to step on anybody's toes. We're here all to work together, try to improve your financial position. So yeah, it does make sense. Don't be afraid to get everybody involved in a conversation.
The next question is going to be, if we were to change governments coming up soon, do you think that this capital gains change is going to stay, or is it going to be removed?
It's a good question. It's been a big political. It's funny. It's been back and forth between liberals and conservatives. So liberals have been trying to put this out there, and they wanted to hear what the conservatives were going to do. And I guess the conservatives realized it was a lose-lose situation to put an opinion out on it. So if they said they were going to get rid of the tax, they said they'd be taxing the poor, giving breaks to the rich.
Right.
And if they included it, they said the rich would be upset because they're increasing taxes. So they put it out to the Conservative Party to give their opinion, and the Conservative Party just said no opinion.
Right.
And which stuck it back. So it was a very, very political move to do. We have no clue. We know the government needs money. Unfortunately, the government has had a terrible, let's say, 5-year run. There's been massive spending in the government, a lot of things going on. And of course, obviously COVID and all the money that's put out, the government's in a rough deficit situation. Even with the high interest rates and everything, remember, the government carries a lot of debt too. So government's in a really rough position with what they're doing. We knew something like this was probably going to come up because we saw no other way for them to cover their budget deficits. So it's not a huge surprise to us. We don't like how it was rolled out. We thought it could have been done much better. As we said, more time would have been nice. They could have let us crystallize gains. So if we feel with properties, you should be able to file a tax, let's say a tax, then crystallize the gains rather than have to trade properties, transfer properties. You should be able to realize that beforehand if you wanted. We don't know why they didn't do that. So we think the rollout was terrible. But back to the question, do we know what they're going to do if they change governments? Not sure yet.
Okay. We're going to do a couple more questions here. One of them being that if you have a cottage property that is your primary residence and you transfer it to your children where it's not their primary residence, would you have to pay capital gains on that?
So the question is, if you have a cottage and it's your primary residence, you're transferring ownership to your children and it's not their primary residence? Great question. So if the cottage is your primary residence, at time of ownership change, there's no capital gain implication. When your children take ownership of the property and it's not their primary residence, the fair market value of the property at the time of the ownership change will be the cost or acquisition cost for them, and that's where the capital gain calculation will start from. And depending on your children's situation, whether they have if they have a primary residence and this is a secondary property, there is the ability to determine in a given year what's your primary residence versus your secondary residence, but all of that doesn't have to get determined until something is sold.
And again, when you're doing this too, there's particularly with cottage properties, there's a big range of what they can go through. So if you're doing a transfer, it's got to be a fair market value. The fair market value has to be established, and it can be established through a number of different ways. And again, when you find it, you want a higher fair market value for that. Because remember, whatever that transfer cost is, it's going to be tax-free to the transferor,
right.
and the transferee, I guess the person who receives it, is going to come in at, that's going to become their new
Their
adjusted
cost.
cost base.
Right.
So again, that's where you need professionals to do the best job they can, because it's going to save people in taxes over the long run.
We'll have time for about 2 more questions. The next one is going to be, if you weren't planning on realizing any capital gains, whether this is a second property or a non-registered account, does it make sense to do it now or wait into the future? Is there a break-even point of a certain amount of years?
You're doing some research on that. I know you found some tools too.
Sure. There are tools that are online that you can use to determine, what is the cost, what is the growth rate that you anticipate. What we've determined is that the break-even point is between 6 and 7 years if you're using a 7 to 8% return rate. Again, the tax savings that you would receive by triggering the capital gain and paying the tax now would be offset if you had longer than a 6 to 7 year time horizon from the gains that would be accumulated longer than that 7-year range.
And the other thing that's up in the air here is, much as the last question said, do you think the next government could get in and get rid of this, right? So you may have triggered and paid all these taxes for zero reason. So that's where we're really hesitant to tell you, go pay these taxes, pay them right up front. We're going to look pretty stupid in 2 years when all of a sudden there's new government in place and they say, no, we're going to get rid of this. And we had people pay tax for no reason.
Right.
So
Our last question for tonight is going to be something that I don't know if it's easily answerable, but we'll try. Why do you think the government made this change?
I would think it's about the fiscal situation that we're currently in. Attempting to pay for a lot of the projects and the plans that they have for all this spending requires some revenue generated in order to be able to pay for a lot of these programs.
there's definitely a situation. So if you think about this, when they brought it in, number one, it's added on a state tax, which I mean, in a way, that's where it's going to affect a lot of people. The other thing is, by doing this, it's the one way where they get people to voluntarily pay tax. So the government is in a financial difficulty right now because of what they went through. This is one where they can get money because people are all going to be triggering these gains inside corporations and volunteering to pay tax this year. The government's going to get more tax revenue this year than they've ever got, right? So they're going to get a quick inflow of capital into the government because people are going to trigger the gains to get it at a lower rate. So this is what really pushes them to get money right now. You can make other tax changes that will affect everyone 10, 12 years down the road. This is going to put cash in their pocket immediately.
Installment payments.
Yeah. April, the government's going to get a good paycheck in April.
Yeah.
Well, thank you, Carlo. Thank you, Mike. If we didn't answer your question today, you can email it to us at tmfg@assante.com. I want to thank everyone for joining us tonight. Thank you to Carlo and Mike for explaining that to us. If you want to check us out on tmfg.ca, we post articles as well as different posts and a podcast that is also on all streaming platforms. You can check us out on all of our social medias, YouTube, Instagram, LinkedIn, Spotify, and Facebook at the McClelland Financial Group. Otherwise, we hope you enjoyed the evening and have a great night.